hallowed halls of the central bank behind me, there's a new debate raging. What's changing India's savings story? Now, it may be a broad generalization, but Indians are generally cautious with their finances. All our lives, we've been told to save and not just to spend, and that's meant that the Indian economy's saving rate is among the highest in the world. But in the last couple of years, that's started to slow down. Is it about high inflation that's simply not allowing us to save? Or is it that we're putting our savings in better avenues because financial avenues are simply not giving good real returns? Asta Maheshwari talks to people, talks to the experts, and brings us this story.
We've sold 10,000.
38-year-old Sandeep is an engineer by profession. He earns 60,000 a month and most of his income goes in supporting his family. But like all other middle-class Indians, putting away a part of his income into savings is something that Sandeep has done diligently over time. Except in the past 2 years, when rising inflation has strained the household budget, meaning that there isn't that much left to save at the end of the month.
In the last couple of months, or let's say a couple of quarters, the expenses have really shot beyond what the incomes have gone up. So finally, savings is where the hit is. So what we used to save, let's say a few months ago or a few years ago, now that the savings isn't that much.
Sandeep's flight sums up the dilemma that many people are facing in the country today. On one hand, inflation is biting into savings, and on the other hand, finding lucrative avenues to invest your savings into seems to be getting tougher. As a result, household financial savings in 2010-11 fell to 22.8% of GDP, after hitting a high of 25.4% of GDP in 2009-10. Household financial savings have also fallen to near 10% of GDP, versus 12.9% of GDP in the previous year. Broader savings across the economy also fell to 32% in 2010-11, after hitting a high of 37% in 2007. While India's savings rate still remains among the highest in the world, the declining trend in savings has started to raise concerns in policy circles.
There have been episodes of very high inflation during this period, and so that's one reason why the household savings might have contributed. In addition, there has also been a slowdown in growth. So the amount of money that people would have, the incomes that they would have during this period would also not have risen to the extent that in periods before, in the high growth period, before 2007-8, it would have happened.
One big factor particularly behind the drop in financial savings has been inflation. Not only does inflation reduce the ability to save, but it also means that returns offered by financial instruments, once adjusted for inflation, are close to negative. Take for instance the SBI one-year fixed deposit, which offers a 9% return. But when adjusted for consumer price inflation, which is at above 10%, the real returns for depositors end up being negative. No wonder then that money being parked in bank deposits has slowed considerably, as is obvious from the anemic 13% deposit growth, which is running at a 7-year low. But bankers feel that the safe haven appeal of bank deposits will mean that depositors will eventually return.
If you really see year-on-year growth, which is about I think 15% or so, and I feel that over the full year, for the full year, the deposit growth should be about 15-16%.
The sluggish and volatile equity markets have indeed been another factor that has dented the confidence of consumers, especially consumers who invest their savings in equity markets, either directly or through mutual funds. However, with the uncertainties in the financial markets still existing, what's been a constant though is India's interest in gold. It's this yellow metal which has become the red-hot option among investors in the last 2 years. The appeal of gold for Indians has always been high, and Indians are among the largest consumers of gold in the world. But in the past 2 years, the demand for gold surged even further, as people started to invest a greater proportion of savings into gold, which promised not just capital preservation, but also capital appreciation. And so total imports of gold into India rose by 44% in 2011-12. Investment demand for gold rose by 5.5% in 2011-12. Investment in gold ETFs also rose 81% between June 2011 and June 2012. As consumers bought more gold to protect themselves against inflation and financial volatility, policymakers had yet another policy headache to tackle. Rising gold imports pushed India's current account deficit to a record high of 4.2%, which in turn sent the Indian currency tumbling to a record low. In order to break the vicious cycle, the import duty on gold was raised to 4%, but the impact has been minimal.
Your capacity to restrict import gold is limited. You can only decide whether it should come on official account or unofficial account, how to manage that. And I say that it's better to have it on official account if it is inevitable rather than unofficial account, number one. Second, demand for gold, and that's where the essay comes in. You must analyze the reasons for demand for gold. And if you want to reduce the import of gold, you tackle the reasons for import of gold.
While the overall savings rate continues to remain high, it has not raised alarm bells as yet. But the shift in savings trend from financial instruments has got the policymakers worried. And this can be tackled only if they ensure that bank FDs and mutual funds start offering higher real returns. And this can be tackled only by concerted policy action by banks and the central bank. In Mumbai, Astha Maheshwari, NDTV Profit.
India's #1 news app just got even better. Download NDTV's new app. Fully optimized for retina display. Full screen view. Faster response time. And Sudoku. NDTV's new iPad app. Download now.